Hello listeners and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. Across Europe, power prices are behaving in ways that are leaving even seasoned market participants scratching their heads. From sudden spikes to counterintuitive flows to very, very low prices, what once felt like a relatively predictable system is now anything but. In particular, I'm thinking of some recent incidents. For instance, April the 6th in Belgium, when balancing prices hit minus 15,000 euros per megawatt hour, and day-ahead prices of 200 euros a megawatt hour for the 14th of April in the price area around Trondheim in central Norway, when prices further north were a mere 8 euros. So what's really going on? Are Europe's power markets becoming harder to understand, or are we simply entering a new level of complexity that market participants will need to adapt to? And when prices behave in ways that don't seem to make sense, what does that actually reveal about the system underneath? I'm very pleased to be joined for the scene setter with our own Alina Trabottoni, who's Italy correspondent, working out of Rome. So a warm welcome to you, Alina.
Thank you very much, Richard. It's great to be on Plugged In.
You've covered the balancing markets and the intraday markets and general markets for a very long time now, Alina. What do you think Europe's power markets are becoming fundamentally harder to understand, or are we just sort of entering a new normal of increased complexity and volatility?
Well, actually, Richard, do you know what? Both, but the distinction you make actually really matters. The markets, at least according to traders and other market players I speak to, well, they don't see the markets as broken. What they say is happening is that the system's actually changing much faster than the institutions, the grids, and of course the contracts can adapt to. So what they're having to do is play catch up, and that gap is what makes prices feel very disorienting right now. And that's because for decades, power prices followed a very specific logic. So, you'd have things like weather, demand, marginal fuel, that would very much have an effect on prices. And of course, it's got to be said that model still works, but it explains less of the day-to-day action than it used to. I mean, at the end of the day, we're shifting from a dispatchable fossil-fueled system to one that's shaped by variable renewables, electrification, tighter cross-border integration, the works. And now prices are set more often by short-term conditions, so things like, solar surpluses, wind output, EV batteries that are already full from the day before. So it's all very different from the well-known smooth fuel cost curve that we were all so used to for so long. Also added to that, algorithmic trading increasingly dominates intraday markets in ways that can cause really sharp, fast moves with no fundamental driver visible. So yes, absolutely, there is a new normal of volatility. But again, I wouldn't specifically call it harder to understand. I'd say it's harder to understand with outdated assumptions. So let me give you an example. If something makes no sense in Italy, it may actually all become clear if you take a wider bird's eye view of the entire region or of Italy and the neighbouring interconnected markets. And once you start to make that shift, a lot of what looks like noise, like confusion, like irrationality, well, it starts to look like logic.
And when prices behave in ways that don't seem to make sense, what does that tell us about the system?
Well, Richard, in actual fact, when a price looks irrational, it's almost never actually rational. It's basically the market revealing a constraint and doing exactly what it should. A negative price, for example, signals oversupply with nowhere to go. A price spike signals the very opposite. So flexible backup may be scarce or demand has concentrated at the wrong place at the wrong time. And today, I think we're all aware that across the board, what used to be considered extreme events or an extreme event, well, they seem to be occurring more and more frequently. And more often than not, those that suffer from these or that are caught unaware are the ones that don't take stock of the changes that are happening and account for them, at least according, again, to the traders and analysts I speak to. But it is true. I mean, what we saw with Picasso, when spikes hit, 11,000 euros megawatt hour in Poland, and Italy as well had extreme price cases, but many other countries as well had had extreme anomalies. This too is a reminder of what happens when market design hasn't caught up with a system complexity and is not accounted for. And there are many other changes in the pipeline that will further affect the system. There's more frequent intraday capacity recalculations. We're seeing that in Italy, for example, in past months. And it's basically the system recalibrating to close the gap and embed the current operations into prices more accurately and more often. So the market isn't becoming random or irrational. It's simply becoming more granular and more demanding of the people trading in it. And at the end of the day, the practical takeaway from, this discussion, I guess, is that irrational prices almost always point to a missing layer. So to storage, demand response, grid capacity, market design, of course, fundamentally. So whilst the volatility is real, so is the information it contains within it. And we need to take stock of it, basically.
It's a brave new world, in other words, then, Lina. Thank you very much indeed for your insights and your explanations here.
Thank you. It's been great to talk to you about this. It's a really interesting topic.
Now I'm joined by Julien Jamon, energy and power consultant, and Frank Berman-Lima, flow-based capacity calculation expert at Tenet, to unpack what's driving these so-called irrational prices and whether they're actually irrational at all. So we're joined by two experts working right at the heart of Europe's power system. A warm welcome to you both.
Thank you.
Thank you.
I'd like to start by looking at what we've seen a rise in what many are calling irrational or weird pricing across Europe, all the way from Norway right down to Central Western Europe. How would you characterize what's happening at the moment, Julien?
So, it depends what you mean by weird pricing, but indeed, there have been some moments where we have seen some not very intuitive pricing. I believe that's basically because we are seeing an increase of renewable, but also batteries and also loads electric vehicle, which is based on batteries. So there are quite a lot more complexity that is coming to the system, which can also have an influence on what we are seeing on the markets.
Could you give some examples, Julien, in terms of how those factors play into some of the pricing dynamics?
Yeah, if you have more renewables, you basically need to have more better weather forecasts. And if you have any issue with weather forecast, if you have some errors in the weather forecast, then you can have a strong impact on what you are seeing in the prices, the short-term prices. If you have more and more weather-dependent resources, it's logical that you will have an increased exposure on the weather forecast. And this is becoming more and more critical as we expand solar and wind. But also, I would say that another example, for example, is the adoption of electric vehicles. That if you have, for example, 2 consecutive days with a lot of renewables, then for the first day, the prices will be already low. So potentially a lot of people have already charged their car. So the next day, with the same kind of, production capacity available, that you might have less demand because the battery has already been charged in a way. So you can have those kind of influences from one day to another, which is basically because we have new kind of loads in the system as well.
And what markets, Julien, are we talking here? Are we talking about the day ahead, the intraday, the different kinds of balancing markets, the ancillary services, or all of the above?
All of the above are a bit impacted, but in a different way. So if we really look at kind of the day-ahead markets, then the weather forecast model are less important because it's for the day before. So, but if you really look at the balancing market and the intraday market, which in a way it's very much linked because continuous intraday is basically also kind of a continuation of the balancing. Then the weather forecast plays a very critical role there. So it really depends on what you are looking exactly and the time frame. But I would say that the weird pricing, the extreme prices that we have seen, it's mostly linked to the balancing market and to another extent to the intraday continuous market, which is kind of a continuum, because market players, they tend to go in intraday also to cover their balancing risk.
Frank, I know you're not an expert on the balancing market, but you work at a TSO. You see some of the power flows. I mean, what do you think are the key drivers here that are seeing these kind of, which some would say strange prices, others would say it's easily explainable due to the dynamics that Julien is talking about. What's your view here?
Yeah, I think I largely agree with Julien, and because when people say strange, it's usually compared to a certain frame, right? So, and I think what we are currently seeing is that we are in a transition. There is a lot of changes at a rapid pace, and then people tend to not always keep up, and then they're like, "Oh, this is strange," when it's actually not. A good example of this is, of course, the introduction of non-intuitive flows. So that means that in the context of a day-ahead market, the day-ahead algorithm, Euphemia, can schedule a flow which at first sight is not intuitive, not logical. But if you look at the broader regional optimization picture, it does unlock more welfare. And you see that when it was introduced in the Central European area, there were people questioning it. And now you see this for the last year, ever since Nordic Flow-Based went live, you also see it in the Nordics. But I think it's partly also tied to the fact that we have a very complex system with differences, and even small input differences can cause quite large swings in your outputs, which any control engineer can tell you about. And then people find this strange. And this is usually, not always, but usually a lack of understanding of certain specific topics, which is understandable because it's a really complex system. But yeah, in the end, I would say, indeed, we are more weather driven. And then this causes certain changes, but they're explainable. But it can occur to be strange at first sight.
And we had an interesting example. I don't know if you followed the markets in the Nordic region, Frank, but prices for today that were set yesterday were in one area around Trondheim in Norway were almost double that of surrounding areas, and whereas the northern area had €8 a megawatt hour, the Trondheim area had 203, and flows were still flowing north to the very low priced area. So for that reason, many would say that's very strange. But you would say that's explainable.
Yes, usually this means that the non-intuitive flow or the strange flow enables an interaction somewhere else in such a way that the total gain of the market trades is more positive, that the business case is improved. And it is really a difference between looking at a specific flow and zooming in on that, while you're missing the bigger picture of the overall welfare optimization. And of course, you can still criticize the way the algorithm optimized. That is totally fine. But what is sometimes a bit difficult in discussions, especially from a TSO side, is if somebody finds something strange and then misses the forest for the trees, basically. So that makes it very difficult. So I always find it's completely acceptable to open a discussion about how Euphemia, the market algorithm, optimizes, but then you should look at the whole region and the grid constraints, and not only look at a certain one price or one flow, because nothing happens in isolation, especially not in the day-ahead market with a Euphemia algorithm.
But if I was a kind of consumer in that region around Trondheim in Oslo, in the NO3 area, I would say, am I being sacrificed for the greater good of the Nordic market as a whole? Would that be?
Yes, and that is a fair comment to make in that moment. But what people forget is that there have been countless studies in this, that if you average your losses and gains, quote unquote, over, let's say, a whole year, that in the end, everybody gains by cross-border trade. But it is possible that these gains are coming at the expense that in certain hours, yeah, sure, you might not be the one optimized. But the overall, over the whole year, everybody gains a lot compared to a fully autarkic situation.
That's the difficulty of explaining this kind of new system, of course, and that's partly the job of TSOs such as yourself, Frank. But Julien, what I find fascinating is that Frank even mentioned it, but such small changes in input, like a car batteries or an aggregated EVs, could result in such different pricing dynamics, and I think that's the intriguing part here. Or the change in EV charging from one day to the next because the cars are full, so they don't need to be charged on the next day when there's a period of renewable output. I mean, that's quite a huge change, and I think do you expect that level of complexity and granularity to continue?
Depends where exactly, but I mean, if you speak about the day-ahead market, which is kind of the basis market, I would say, I expect that volatility in the prices will probably increase because we'll have more differences between a day with renewables and a day without renewables. So a day with battery are empty and battery are full, if I can be very simplistic. But so I expect this volatility to increase there in the day-ahead market. But in the balancing time frame, which is much closer to real time, I expect quite a reduction in the volatility somehow at some point, because we'll have more and more battery capacity coming into the market. So that should actually stabilize, the very short-term differences that we might see, which is probably not what we are seeing today, because we are still in the kind of the starting phase of the boom for large-scale batteries. But at some point, I think it will stabilize. But the volatility in the day-ahead market will probably be increasing for the next few years at least.
But if I'm a renewables producer, I don't know, in some part of Northern Europe on the continent, and I have 100 megawatts, and I see, either I need to get absolutely the best weather forecasts available, which is not cheap, or is there a case where I could maybe just hold off and not go into the day-ahead market, but go into the intraday market where prices are a little bit more stable or not as volatile, because I could be hit quite badly?
I wouldn't necessarily call the intraday market less volatile.
Okay. Okay. Fair enough. But I was thinking, like, in terms of, so that's a fair comment, Frank, absolutely. But we are, anecdotally hearing stories of people not, or not going fully in with their volumes in the day ahead, holding back. I mean, is that a fair assumption, Frank? That's, if you...
It's a risk appetite question, I would say, because it can be true that the intraday market is less volatile or more predictable because it kind of oscillates around the day ahead market. Price-wise, you can usually say, but there is a huge increase in algo trading, so algorithmic bots in the intraday market, which can cause very violent volatilities from time to time. And that creates a risk that is hard to predict from time to time. So if you're in the intraday market, you need to be really prepared that it can go really fast up and down. So when I talk to market parties, you hear that less and less market parties are manually clicking in the intraday market because you cannot compete with bots that are doing that. This is different from futures, where the volatility is much lower and the volumes are lower, and the day ahead market, which is an auction, so you don't need to be the fastest. And so that if you have a certain risk appetite, then yes, it can help, but you need to have some specialized knowledge for this. And that makes it quite difficult. And a famous example of this is, for example, if you have intraday auctions, which we have 3 times in the day, we close cross-border trade as a preparation for the intraday auction, or IDA as we call it. What happens is you can actually see in the order books that algo trading will push the prices apart from each other, for example, between Netherlands and Germany, without a true fundamental reason. That's just algo bots trading on cents against each other to test each other out. And then once the gate opens again after IDA, these order books collapses and you see a huge peak in volume. That's purely algo driven. There's nobody who's like chilling at his desk at 10 in the evening and going like, oh, you know what I'm going to do? The gates are closed. Let's move the market. That's just bots. So it really depends on your expertise and risk appetite, I would say.
But is that the best? I mean, there's probably a discussion. Is that the ideal market structure and the ideal system that we have? But that's for another podcast, maybe, Frank. But what's your view here?
Very shortly, for me, yes, because the idea of day ahead is that it can fast respond to changing situations on the day itself. Is it logical that this becomes in a fairly large amount automated, because then you can react fast to it. It becomes kind of a precursor to balancing. For me, that is fine, but I know not everybody looks at that. But to me, that is then the role of the intraday market. And if you have the more foundational strategies with humans, that will be more a day ahead market because you have more time for it as well. but I don't know what Julian thinks.
What do you think, Julian? I mean, is it the day ahead is got the human touch, and the intraday has the machine touch, as the slave to the algorithm?
I mean, I will tend to agree, because basically, as Frank was saying, is that the day ahead is more like the kind of the basis market, where like most prices will be settled. Also, the future market will also be settled against the dead market. So it's kind of like the reference market. And then everything that is after the dead market and before real time can actually be due to the difference between what you expected the day before and the reality. And this can really be done by algorithmic trading, especially in a context with a lot of large case battery coming to the market. Those algo traders with the batteries, they can really actually deal with this kind of short-term deviations.
No, it's a fascinating area which we're moving into, I think, and in terms of the market, the way it operates going forward. But do you think traders and operators, producers are equipped to deal with this increased complexity, Julian?
I mean, I think they will have to adapt. So it's not a matter of are they know, it's the matter of more like are they willing to make the process their process to be equipped for that. So they will have to invest in this kind of technology and the kind of way of trading. It's an adaptation process, but at the end of the day, they will have to. That's my feeling.
And maybe AI will come in here as well and help out, Julien.
Yeah. I mean, yeah. Of course, AI will help somehow, but I mean that's. I don't like to say I will save the world, So
yeah, no, certainly not saving the world, but maybe
No, that will help for sure, but the fundamentals still has to be understood, and the fundamentals of why we can see sometimes the real prices, which Frank has explained that there is always kind of a reason for that, and the fundamentals have to be understood by the people that actually write the codes for the algorithmic trading. But of course, those coders, they will help by AI to make the process more efficient.
Frank, what's your view here?
I think AI is a bit of a hype term, right? I think deep learning models, machine learning, has been used, especially in weather forecasts, for ages now. So that's not a new development. Certain inputs to the TSO process also use this. So it's not that strange.
Mm-hmm. Fair enough. I mean, do you think in terms of, the system is growing in complexity when you come down to the granular level of EV batteries and, certain demand centers and general, the consumption and production picture. Are there more system changes coming, Frank? Can we expect more changes to the markets? Could you explain some of those and how they would work?
It's actually a pretty busy year, to be honest. So last year, of course, we had the change from hourly to 15-minute time blocks in the day-ahead market, which is a pretty big change. And a lot of capacity calculation changes were waiting on that. So for example, we now have the upcoming, this year. One of them is advanced hybrid coupling. So that means that we forecast borders between different capacity regions better. So, for example, mainly between the continent and the Nordics, that we forecast the effects, and we take the effects better into account. And so that's one big change. Currently, this is foreseen in May to go live. So let's see if we make that, but hopefully yes, 20th of May. And then also soon, we will release more updates in intraday markets. We will release new intraday capacity calculations updates, basically. So throughout the day, what we do in intraday is we every 6 hours we run, or this is foreseen in the end, every 6 hours we update the capacities for the remaining hours of the day. And currently the first 3 calculations have been implemented, and the 4th and the 5th will go live this year. And that's quite an exciting change, because the thing is that in intraday we trade in an A to C manner. So that means that you have a single capacity number per border direction. While in day ahead, we have this fancy flow-based domain, and it can encode all kinds of situations. So in intraday, what we do is we still calculate the domain, and then we convert it back, or we extract basically a per border capacity. We simplify it because the intraday allocation is a simpler mechanism. And the problem with this is that you cut away some capacities, and we do this in an equal way. So we say that we treat all borders equal, but in a market, not all borders are equal. Certain borders make more economic sense to give more priority. And in a way, you can solve this by simply running your extraction more often. So if you update the capacities, and every time you again distribute all capacities across all borders, you will open up certain borders which have been used by the market at the expense of others which have been used less. And so this year we will release what we call IDCC D and E. It's just a strange numbering, but it's basically the fourth and fifth calculation during the day. And then traders will see more updates of capacities in an intraday time frame. And that's really exciting because then it's an efficiency step. Because if you do the extraction more often, you will open up borders in which the market is pushing, if possible, of course. And that really helps the intraday market. So that's really cool. So those are two big changes, and that's really the upcoming months. And the other one that I try to name everywhere that I go, because a lot of people forget this, is the removal of long-term capacities in the day-ahead market. So currently we force long-term capacities in the day-ahead market. That is always guaranteed that this is available in the day-ahead market. And that will be removed. It will become completely a virtual financial product. Hopefully at the end of this year, we're currently going through the regulatory process for this. It is not final yet. The other things I talked about are final. This is not final yet, but that's it's being built. So, and these can have quite major impacts on day-ahead and intraday. And they're all going live this year. So that's really exciting, and something to be aware of your market partner.
Okay, absolutely. So, and this will increase the transparency for all market participants, you're saying, as well.
Yes,
frankly.
yes, because every time we do a recalculation, we publish everything again. So you have more moments in which there is a transparency from us, the TSOs, what we're doing, what we're seeing in our grid models, and how much capacity that releases. So this also brings more transparency. And you can, of course, start forecasting this. There are certain fundamentals under this. It's not, we don't spin a random number generator, which sometimes people think that there is a fundamental reasoning about this, and you can forecast this as well. It just becomes more complex, especially AHC is advanced hybrid coupling, makes it a bit more complex. But I need everybody to be aware of this and not be caught out.
Yeah, exactly. So we'll come back and say we don't understand the pricing or the capacity calculation, and then you're saying exactly that. So Julien, if I can come back to you, I mean, Frank mentioned the move to 15-minute trading, the trading period. What's your view here? Has that been a success?
I guess yes. I mean, I don't have anything to judge. It was not a success, so I guess it's working fine. So I guess it's a success. I mean, we still see this seesaw pattern. But I guess with time that the market will kind of adapt between trading hourly and trading quarter hourly. But yeah, I mean, I don't have anything to say that that was not the success.
Okay, excellent. What would you say about, we talked a lot about these volatile prices, and sometimes, although they're explainable, they may seem a little bit odd. Do they provide the right market signals for investment and for those trading decisions, Julien?
Yeah, so that's I mean, I would say that two different things. So the first thing on the investment signal, I mean, investment in the energy sector, it's for very long term, so it's like 10 years and plus. So this is the basic question: do like energy price signal actually enough to justify any investment? And I believe that the answer is probably no most of the time, because it's very short term. We have seen quite dramatic changes actually in the energy market. So if you remember, in 2020 it was COVID, so oil prices were very low. Then we have this energy crisis where extreme high prices everywhere, and then now we have this surge in solar, and so we have seen in 5 years like dramatic changes. So as an investor, I mean, if you have to decide on an investment and only based on the energy prices, it's actually extremely difficult to make any investment decision. So we have this missing money problem, which basically means that we have capacity market that are in quite a lot of countries now. But we also have this support for renewable, like contract for difference, that are like also in quite a lot of countries. So because to make an investment decision is quite hard just based on the energy prices. And then the other part of the question is more on the trading signal to do like some short-term trading. And I would say that's they're basically enough, yes, to make trading decisions. And yeah, they're safe for that, I would say, because at the end of the day, like those signals, they're there to kind of optimize what we have compared to what we need for like the short term, but not necessarily for the very long term, which is more like investment decisions.
Absolutely, but then the investment decisions into batteries or into solar production would come when people would be looking at the current volatility and the way the market's operating, right?
Yeah. But I mean, if you really want to invest in solar, just purely solar, there will be less and less country where actually it makes sense purely with energy prices. So of course you will have like those projects which is co-located solar with batteries, which can make sense. I don't say they will always make sense, but they can make sense. But then even batteries at some point, they will have to, they will probably need also some kind of a capacity market to make the investment decision bankable. So it also depends very much from one country to another. But yeah.
Absolutely, and we've talked about the complexity, the volatility, but looking to the next 6 to 12 months against the backdrop of a severe energy crisis due to the war in Iran. If we look at the Central Western European power market, what are the key risks and opportunities that market participants should be watching now, Frank, do you think?
Yeah, so of course there are a couple of things. You're right. Indeed, we are looking at a very uncertain situation surrounding the gas market, and gas market still has a very dominant effect in the day-ahead market, simply because we have the marginal pricing. So I think that is going into the summer the biggest question mark, because a lot of the other things are following a more or less predictable pattern. Of course, renewable build out, etc., that follows a certain trend. So I would foresee that the gas market influence is the biggest one right now. And then for the general system, because, for example, changes like AHC will not suddenly hugely change prices. It will make it more difficult to forecast capacities, and it's a bit more complex and will be more efficient, but it will not suddenly swing the prices. So to me, the main thing indeed is the gas thing. And of course, will there be another heat wave? Because if we have a very severe heat wave, especially in southeastern Europe, you get this double effect of high increase of your load because people turn on their aircos, while at the same time, and I think a lot of people in the general public miss this, is that generators will shut off if they cannot lose their cooling. So especially nuclear reactors are really sensitive to this. It's also, of course, for France, but there are also some in Eastern Europe, which shuts off if they cannot lose their cooling. And that happens in the past. I think most famously in 24, it was really extreme. In 25, it was a little bit less extreme, but it can happen again. I'm reading some publications about scientists warning that there will be a big new El Nino effect. So this global warming always goes a little bit up and down. That goes to a higher again, and then we can have some severe strains on the market in the summer. I think that's really those two things, a heat wave and gas, and especially the combination of those two. It could be difficult. And also other effects, for example, if the rivers go lower because of low rainfall and a lot of heat, then also stuff like coal transport in Germany is threatened. So all of these weather things can hit quite severe if they all go at the same time.
A cocktail of different factors. What's your view, Julien? Do you share what Frank is going to say? Maybe any other risks or opportunities?
Yeah, no, I completely share what Frank was saying. Just to add on the heat wave, it's also if you. I've lived in Southern Europe, so I can tell you that when you put your air conditioning, it's not doing the when it's midday, but you put it in the evening when you don't have solar anymore. So basically, you have, people tend to figure, but you will have solar, but actually it's kind of like a few hours difference, which makes a big difference for the power system. But yeah, I will say that people should look in the next 6 or 12 months. That was your question. It's more on if you get rated to like kind of fat tail distribution, so the extreme events that can happen but are not so rare. So we have seen that last week in the balancing markets, which has also had effects on the intraday market. But those events, it's important to try to see when they will happen, because that's where you want to be hedged against them if you're exposed to those prices, or it's where you want to be available for delivering if you can profit from those prices. So those it's all the prices are not in a very nice normal distribution. You've got some fat-tailed at the end of the distribution, and it's during those moments that you might want to capture all those very beneficial prices.
Yeah, absolutely. By increased forecasts being very well, there's massive risks out there, I think, and people can get caught out quite easily if they're not on top of the game in terms of forecasting and the bigger picture. Absolutely. Frank and Julien, thank you very much for being guests on the Plugged In podcast. And a fascinating discussion, and I think it's just an introduction to maybe what's coming in the months and years ahead. So great to have you on board. Thank you.
Thank you very much.
Thank you for having us.
And to you listeners, thanks for listening to this episode of Plugged In. If you enjoyed this discussion, please like, rate, and follow to make sure you get the latest podcast episodes as soon as we release them every Thursday. We'd also love to read your reviews of the podcast. It helps us to keep up to date with what you, our listeners, think of the podcast and what content you want to receive more of. Finally, you can head to montelnews.com for more news and analysis from our team of journalists across Europe and beyond. See you next time.